Hey Bowtie Nation, Joseph Hogue here with the monthly update to our 2021 stock portfolio and 3 stocks I'm adding in September. Nation, this month I'm taking advantage of one of the biggest sell-offs in the market last month to load up on what could be one of the biggest investing themes for the rest of the decade. Now to be honest, old fart that I am, I've been skeptical about gaming since laying down the controller on Final Fantasy IV back in 1991. Now they're up to like Final Fantasy 99, Ryu goes on Social Security, and I'm just like, what a waste. But games have become so much more than just getting blisters on your thumbs. Gaming has grown into a social media phenomenon. A survey by Accenture found that more than 80% of gamers prioritized connecting with others and meeting new people. Turns out only 44% used video games to vent and trash talk. Yeah, I'm looking at you, Noob Troll 69. Gaming has seen explosive growth over the last decade, even before the pandemic, and could be about to enter a new era of monetization for these game makers. The US gamer population alone grew 5.7% last year, and while that's expected to slow a little, is still going to represent over 150 million people, with 26 million in the faster growing esports segment. And internationally, the industry has added more than 500 million new gamers over the last 3 years, and Accenture forecasts another 400 million is going to join by the end of 2023. So the numbers are there, but monetization is still underdeveloped. ARC estimates the cost per hour for gaming monetization is under 35 cents. That's less than the rate on social media platforms, online music, and less than a third the rate for traditional cable and media. In fact, as the gaming industry develops, ARC is forecasting that monetization rate grows by 20% annually over the next 5 years. Here, ARC is estimating just in-game revenue could jump from 130 billion to as much as 350 billion by 2025, with even the more moderate base case seeing 12% annual growth. Gaming stocks have taken a huge hit over the past month on fears that an end to the lockdowns would mean lower revenue and growth as gamers just came out from their mom's basement, but we know that's not going to happen. Gamers are going to game for that social interaction, and the increase in monetization for this industry is going to continue to drive revenue. I'm going to focus on the game developers with our 3 September stock picks, but I wanted to share this chart by Accenture showing direct and indirect revenue streams to the industry as a great place to start when you're looking for other gaming stocks. The firm estimates $200 billion in direct revenue through those in-game ads, hardware and software sales, and then an additional $100 billion indirect revenue through mobile devices, esports, content, and accessories. I'll be adding these 3 gaming stocks to our 2021 Bowtie Nation portfolio on Stock Card. The portfolio is up 24% so far this year, beating the market by 10%, which is down from that 35% we had in March, but still got to be happy beating the market. A lot of those returns have come from just a few sectors, like energy stocks and financials. We've booked better than 40% on 4 stocks, including Wells Fargo, Lyft, Devon Energy, and Diamondback, but I wanted to diversify the investments a little more here to get a little more exposure into those growth segments like gaming for our September picks. I'll leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the portfolio. And as a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation, it's all one word in lowercase, for an exclusive discount beyond the free trial. I'll reveal those 3 stocks to buy next, but first, I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Our first gaming stock edition, Take-Two Interactive, ticker TTWO, probably has the strongest titles in the industry with Grand Theft Auto, NBA 2K, and Red Dead Redemption. And something we'll see in all 3 of these stocks, and really across the entire gaming space, is that all of these sold off hard on the earnings earlier this month. Take-Two was down 10% on a second quarter release, but I think it puts these as firmly in value territory for that long-term story. The company reported earnings of $1.30 a share, which was up 69% from the same quarter last year, but sales did fall by 2% to $813 million. Now here we can see the last 3 years' growth of 23% annually was pretty stellar, but older games accounted for 92% of those net bookings for the quarter. It just hasn't launched anything new lately, and that's what's limiting that top-line growth. And Take-Two did release a free update to its GTA franchise in the quarter, but will release a standalone version in November, which could be a good boost to sales and sentiment. The company's also releasing its top-selling NBA 2K franchise in September, and the recent acquisition of mobile developer Nordeus really strengthens the mobile portfolio and brings its first soccer offering. Take-Two has the best cash position of the 3 stocks that I'm adding in September, with $2.5 billion in cash against just $188 million in debt. That means it has more than 2.3 billion, or about 12% of the market cap, just in cash, which I expect is probably going to mostly spend on acquisitions to recharge that growth. Analysts have an average target price of $214 a share, about 32% higher from here, and those upcoming launches could help it get back there. Esports leader Electronic Arts, ticker EA, is one of the largest gaming companies and the largest on our list at $40 billion market cap. Shares fell about 6% after the earnings announcement earlier this month, but have since regained most of that loss. Now, sales were up 6.3% in the first quarter of its fiscal 2022 year, which is a little bit slower compared to Take-Two, but I think the selling is overdone here, and EA has a really strong long-term upside. Revenue was up last quarter on its strong launches for its Mass Effect and It Takes-Two games, and the company has some really strong titles coming up for the rest of the year. It launches Madden 22 this month, followed by FIFA 22 and Battlefield 2042 in October. It's been 3 years since a Battlefield refresh, with over 210 million views on the trailer since that June announcement. But where I really like EA though is in its dominance in esports, with over 140 million players on its sports titles alone over the past year. After maybe casino games, I think esports is where we see that strongest monetization over the next few years, and EA is set to take advantage of that. Despite weakness in earnings because of higher operating costs, the company still repurchased 2.3 million shares last quarter and 7.2 million over the past year, about 2.5% of the shares outstanding. That combined with a dividend payment speaks to management's confidence in cash flow going forward. The company ended the quarter with $3.7 billion in cash against just $2.2 billion in debt, so this is another cash positive company and should have no trouble funding acquisitions or more share repurchases. Management expects full year revenue of $6.85 billion, so shares trade right around the industry average of 5.85 times sales. Analysts have an average target of $169 a share, just slightly above the current price, so maybe not quite as much value play here, but I do like that long-term picture. Shares of mobile games leader Zynga, ticker ZNGA, plunged 18% earlier this month, but are firmly in value territory. The company reported second quarter sales that beat expectations by 5.9% to $720 million and posted an unexpected profit, but it did come up short on expectations for user growth, even though daily active users were up 87% to 41 million, and the monthly active users nearly tripled to 205 million over the last year's quarter. And Zynga is leading in the shift to mobile gaming, with 97% of its revenue from smartphones. It's focusing on upcoming launches of Farmville 3 and Star Wars later on this year, as well as an acquisition strategy that's driving growth. The company is set to add more than 700 million monthly users from its Chartboost acquisition alone, along with Rollic, which broadens its exposure into that hyper-casual gaming market. Now, cash on hand rose over the quarter to $1.5 billion, just covering its $1.47 billion in debt, so really in a debt-neutral position, even with that heavy acquisition strategy. Now that's a good sign, as it adds to that growth without getting weighed down by too much debt. And after the sell-off, shares are trading for just 3.5 times sales, which is by far the lowest in the group, with that average around 5.9 times sales for the industry. Management expects to post $2.73 billion in full year sales, which would be growth of 38%, and the average analyst target of $12.08 a share is 47% higher from here. Click on the video to the right for the 5 stocks with the potential to become the next Apple, 5 small cap companies with room to grow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.